now. Yes. Okay. Thank you, everyone, for joining us on today's session for estate planning. Uh, Thrilled to see so many people joined in. I know it's a really important topic and something lots of people are curious about. So, for those of you not familiar with myself, my name is Andrew Wall. I'm the managing partner here at CPA4IT, where our mission is to help our clients organize their finances, create wealth, and transform wealth into a legacy. And today we are talking about transforming wealth into a legacy, and specifically, we're talking a little bit about estate planning. For those of you who are not familiar with estate planning, its purpose is to ensure a smooth transition of your assets and, for our clients, their business ownership um, through to the next generation. And the goal here is to minimize the tax liabilities wherever possible, and provide for your family or beneficiaries in a way that's clear and concise and that everyone has a vision for. There are lots of challenges when dealing with this as an owner managed businesses, because not only do you have your own family issues to worry about and your other assets, but now you have this entity, your corporation, which for many of you is a large concentration of wealth. At least that's the goal, right? Organize your finances, create wealth, and transform wealth into a legacy. And for our clients, we try to leverage your corporation as a tool for creating that legacy. So, along with that comes succession planning and the complexities that go along with that. And the reason that that is an issue is because of subsection 75 of the Income Tax Act, which says on death, a taxpayer is deemed to have disposed of all capital property at fair market value immediately before death, triggering capital gains or recapture um, of those gains, of those losses. So, what does that mean for your corporation? If you've done your best to keep your finances organized and create wealth inside your corporation, and you now have this asset that you're going to pass on to the next generation or to an important cause, you want to do that as tax efficiently as possible. And that includes a number of things to do to plan for that inevitability. Obviously, you would have a will for all your normal assets, but it's quite common to have a will for your corporation as well. You might have things that you want to take place. One of the most common is a pipeline maneuver, which we will talk about in a second. But the goal here is figuring out, where do you want these assets going? Is it to your children? Is it to an important cause? And how do we get it to them as tax efficiently as possible? And there's both pre-mortem and post-mortem planning that can take place. On the pre-mortem side, we want to make sure that we've got a will and a will for your corporation. We want to figure out what is the plan with our corporation, and that largely depends on how much we have in the way of assets inside of our corporation and what they're in. So within the corporation, there's sort of two common scenarios that we see quite regularly. There's a scenario where you've built up a lot of retained earnings, either in a separate holding company or within your operating company, and the business itself is not truly a saleable asset. So someone's not going to come in and buy the business from you. In which case, you're really just focused on how do we transfer the assets or the retained earnings that I have in my corporation to my children as efficiently as possible. And the problem is if you do nothing, what will happen is the estate will be taxed as a capital gain on the value of the corporation as retained earnings, and then the kids now own the shares of the corporation, and when they go to withdraw the retained earnings out of the corporation, they're going to be potentially double taxed on that, taxed on the capital gain and then taxed as dividends if they withdraw the funds. So a common strategy that is often done post-mortem for those is the pipeline maneuver, which we've talked about before, and I'll go through a little bit more in detail again in post-mortem tax strategies. But if your corporation is saleable, like my practice, my accounting firm, I bought it from my dad, and I'll sell it hopefully to my children or to another CPA when I get down the road. If you've built a business that is saleable, then your planning is a little bit different. Because one of the things that you want to look at is leveraging the lifetime capital gains exemption. So if many of you know, there's a lifetime capital gains exemption that is indexed for inflation. It goes up every year. But what that basically means is if you sell the business, that the proceeds from that sale of the business can come out up to that capital gains exemption tax free. Now, often, and in some situations, you will exceed the lifetime capital gains exemption. And there are options and strategies for minimizing tax in those scenarios as well. And that's by leveraging things like trusts. The one of the big benefits that you get out of the trust is the ability to multiply the capital gain based on the number of beneficiaries. So if you had three children, you could potentially be looking at 3 lifetime capital gains exemptions and minimizing those taxes. So on the pre-mortem strategy, if you've got a corporation that you think you're going to sell either pre-mortem or post-mortem, then looking at setting up a trust is a potential solution that can save you some taxes. Now, along with trusts, another common strategy that is pre-mortem would be estate freezes. And estate freezes, again, let's say that corporation has a lot of retained earnings. Now, in this case, you'd want to make sure, let's say that you have a corporation's got a lot of retained earnings and you still have a saleable asset as a business. Well, what you want to do is make sure that you have a holdco opco situation, because if more than 90%, if more than 10% of the business assets are passive income, then you can erode your ability to use that lifetime capital gains exemption. So there's a strategy often referred to as purifying, where you're taking out all of the assets, making sure that they're in a holdco, which quite frankly, if you're a client of ours, typically once you have enough assets in the corporation, we're going to recommend a holdco because there's tax minimization strategies that we can leverage with a holding company. But if for whatever reason it's all intermingled, the first step that you're going to want to do is make sure that you go ahead and purify that corporation, take out those passive investments, separate them into a holding company, and then you can still sell the operating company, get the lifetime capital gains exemptions. And with the holding company, what we might have is a large amount of assets that are going to be appreciating, between now and when you pass. And what an estate freeze allows you to do is the estate freeze allows you to lock in the value today and say any future growth will be assigned to the beneficiaries or to the people that you were transferring the estate to. So you can do a estate freeze and a trust, and now you've got a tremendous tax advantage because any future growth won't be taxed to the estate. It will be taxed to the new owners when and if they realize a capital gain. So those are some of the pre-mortem tax strategies that you can do. Now, if we get to the situation where we're post-mortem, and this is where having wills and plans and communication with your children is absolutely critical, is because one of the important things with a pipeline maneuver, which one avoids double taxation and also allows you to move potentially dividend income into capital gains, which for those of you who are not familiar, the advantage of having a capital gain over a dividend is right now, and who knows with our government, but the former liberals were trying to raise the inclusion rate, but right now the inclusion rate is 50%, which means that you only pay tax on 50% of the gain, which is a big potential advantage for you over a dividend where, yes, it's a lower tax rate, but you're going to pay taxes on 100% of it. So with the postmortem, there are a couple of different strategies that you can use, and the pipeline is probably the most commonly used one. But the criteria here for a pipeline is that the business needs to continue to operate for at least 1 year. And so what happens with a pipeline maneuver is we do actually go ahead and create a new corporation, and that corporation needs to continue to operate for at least a year. Now, that corporation may only be a holding company, and there's no operating activities in the traditional operating sense, but it's still operating its holdco, its investments. It needs to do that for at least another year in order for the pipeline maneuver to work. There are other strategies if that is not feasible, if all the money does get withdrawn at the time of death, which is less tax efficient, but there are always options available to you. And what we're trying to present are the most tax efficient options. And so I've got a first question. Is this session only for incorporated businesses, or does it apply to unincorporated self-employed as well? Now, this is primarily focused for our clients, which are incorporated owner-managed type of businesses. So I'm sorry if this isn't a fit for yourself. But what I would certainly recommend is, there's still, from an estate planning, figuring out what you have in the way of assets, and understanding that, things like your primary residence will be capital gains exempt. But if you have other assets like unregistered investments, those types of things, those will be subject to deemed disposition as well, and will be deemed to have been sold at their fair market value, and taxed and the estate will pay tax on that. So those are factors. So making sure to leverage your home, which is capital gains exempt, your TFSA, which the estate won't pay any tax on. And the most common pitfall, and just to share some advice for people, whether they're incorporated or not, is the RRSPs. And RRSPs are a very effective tax deferral tool. But what often happens with a lot of estates is that people pass away with a lot of money inside of their RRSPs. And what that means is that the estate's going to pay tax on that, often at the highest marginal tax rate, which takes away some of the big advantages of an RRSP. The ideal way to leverage an RRSP is you contribute to an RRSP and get a deduction when you're at the highest possible tax brackets, and you withdraw the money from your RRSP when you're in retirement and you're in the lowest tax bracket. So hopefully you're moving money from a high tax bracket down to a low tax bracket, plus getting the advantage of deferring when you pay tax from, maybe when you're in your 20s to when you're in your, 50s, 60s, 70s. But the worst case scenario here is, I get my focus back. The worst case scenario is you contribute at the lowest tax bracket and you get taxed at the highest tax bracket when you pull the money out. So really what you want to do is make sure that you're using your RRSP to fund your retirement, and leveraging other tools like the FSAs to save for retirement, because those won't be taxed to the estate when it passes on. And of course, leveraging corporations as well as a tremendous tax deferral, as well as tax reduction strategy that we can leverage. So hopefully that answers your question. And of course, if there are other questions that are coming up, please feel free to post those in, and we'll go through those as they come up. So as we mentioned earlier, there is the deemed disposition on death. there are pre-mortem and post-mortem strategies. Now, again, when it comes to pre-mortem strategies, if you are using trusts, there used to be substantially greater benefits of trust when it comes to income splitting. But there is something you should be aware of when it comes to trusts, and that is that the TOSI or tax on split income rules do apply to trusts, which means if people aren't actively involved in the business, they will pay a higher tax to get money out of those trusts. And like I said, the big benefit is going to be the capital gains multiplier. So if you're looking at doing that, that's where the trusts are really going to have a big advantage. But if you're looking at using a trust in the form of income splitting and distribution, a lot of those benefits were wiped out by TOSI or tax on split income, unfortunately. But what they do still provide is a great tool for succession planning and specifically control, because you can have a lot greater control over what the funds in the trust are used for. It's a way effectively to rule from the grave. They do provide some additional creditor proofing, which is good, but again, I wouldn't necessarily use a trust from that standpoint. Now, the real practical considerations here are timing and figuring out when is the right time to potentially set up a trust, or when is the right time to do an estate freeze. And this is certainly this is a lot more of an art than it is a science. And, if we had a crystal ball, we knew what the future was going to hold, it would be super easy, but we don't. So oftentimes we try to get a better picture for what is the total assets that an individual has, how much money is in RSPs, how much money is in TFSAs, how much money is in the corporation. And typically what we want to do is put together a plan or a strategy where we're pulling funds first from the RSP, then from the corporation, and from the TFSA last from an estate perspective. And then as far as whether now is the time to do an estate freeze, will again come down to, well, what's the plan with the corporation? Is the plan that you're going to be drawing more money out of the corporation to fund your retirement, or are you going to be able to fund all of that out of an RSP? Because if you're able to fund all of it out of an RSP, you might want to consider doing an estate plan or an estate freeze now, because you know that those assets are going to transfer to the estate down the road. So if we can get future growth attributed to the children as opposed to the estate, we can potentially lower and mitigate our taxes. Those are the key things that I wanted to cover. I did want to talk a little bit about a pipeline maneuver in a little bit more detail. Let me just pull up my notes here if I can find it. And of course, I do have that here. So I had I wrote through a plan or a step-by-step scenario with, let's imagine that you've got a corporation that's got $500,000 of retained earnings. And what would be the steps and the process to go through a pipeline maneuver if that's what happens? So step one, you're going to actually transfer the OpCo's shares to a new holding company, which we'll call NewCo here. The next step is that OpCo becomes a subsidiary of the new company. Then the OpCo will continue its new business in the new company for a period of time, at least 1 year. So that's pretty critical, as we did say before. Then we're going to wind up the OpCo into the NewCo. This is not required, but is the most common process that you'll go through. Then there will be a gradual repayment of the promissory note which was exchanged for the shares when we set up the new co. And Newco might repay that promissory note, maybe in annual installments of $100,000 over 5 years. And this means that there's not going to be a double taxation because it's just repaying a promissory note. And that's sort of the end of the process. So you're getting that money out over a period of time, minimum 1 year, in order to avoid one, double taxation, and two, the other option, which is at death, the shareholder takes all the remaining retained earnings out in the form of a dividend and or salary and closes down the corporation. So being able to take it as a capital gain is going to be more favorable, but it does mean it's over a longer, more elapsed period of time. So hopefully this is, a strategy that I think makes sense for the majority of our clients who don't have a saleable business. And it's the most common strategy used in estate planning. Now, with any of these strategies, there are a number of team members that you would bring into the planning of this. So you'd want to have, a lawyer to draft up wills for your estates. You'd also want to bring in a tax lawyer or potentially estate freeze if that's something that you're considering, for a pipeline maneuver if you end up doing that, or for trust if you end up setting up either of those. You're going to need a tax lawyer for those. We had hoped to bring in, there's a tax lawyer that we have worked with in the past. We had hoped to bring him into this session, and we will bring him in future sessions. I promise you that. If you are looking for a referral, we're happy to make a referral on to those. Again, these sessions we're doing to help educate and inform our clients on the most common strategies when it comes to estate planning. We ourselves are not estate planners, we are accountants, but we do come across these issues over and over again and more frequently now as our population is aging. So I do see that there are some more questions that have come through. I'm going to try and address those now. So I got a question here, whether I'm referring to a specific type of trust, of whether that's a living trust. So, I mean, I hate to be the guy to say this, but every situation is unique. I'm usually referring to a family trust, which is the most common thing that we see set up. But every situation is different. It does depend on it. And we have another question about the estate freeze. And someone missed the first 5 minutes, which I don't think we really covered the estate freeze in the first 5 minutes, but I'm happy to dive a little bit deeper on estate freezes as well. So how an estate freeze works. So it's a share exchange. The business owner, often the parent, exchanges their shares, which participate in the future growth of the company, for fixed value preferred shares. So these preferred shares are usually redeemable or retractable at the fair market value of the common shares at the time of the estate freeze. So whatever the value is on that day, it's locked in and it's effectively frozen. So there's this new class of preferred shares that are exchanged. And we will also issue a new class of shares, often called growth shares, but they're new common shares, which will now capture all future growth in the company's value. So let's say that you have $1 million and it grows to $1.5 million. Now your shares are locked in at a value of $1 million, and these growth shares are now worth $500,000. There is often a price adjustment clause to avoid, some adverse tax consequences if the CRA does challenge things of the fair market value. So this is all part of the strategy, and the main benefits here are, for capital gains, tax planning, for future growth. They can also be leveraged if the business does qualify for the lifetime capital gains exemption. This strategy does often go hand in hand with a strategy to multiply that so that we can get the benefit. But again, for our clients, not necessarily a big advantage. But it does also provide some probate fee reduction, because by transferring the future growth out of the parent's estate, the value that's subject to the probate fees is less. So that's another small advantage, but is an advantage. And again, it's the big advantage here really is the deferral of the tax on that future growth, right? So the estate's only going to pay tax on that $1 million, not on the $500,000 that is now attributed to the new shareholder. So also, good for, succession planning and asset protection and family harmony and flexibility and all those things that go along with it. You do want to be careful and cognizant to look at the attribution rules, the, GAR, general anti-avoidance rules, the valuation of the fair market, and, refreezing transactions if the value of the corporation drops after a freeze. So a refreeze can be done to reset the preferred shares to a lower value if that does happen, which you never know in this market. Who knows with Trump running the US and, sending the military after his own people. But I stay away from politics. I've been told by Rachel over and over again not to do that. So hopefully that answers the question on estate freezes and where those play a factor. If anyone has any other questions, be happy to answer those now. And curious to hear from everyone. Love to hear what other topics that you would find helpful in these sessions. We try to keep them short and sweet and drive right to the point. I also would love to hear feedback, if you wouldn't mind sharing what your thoughts are on us doing this without a slide deck. We are experimenting and to work better when we're doing shorter clips of this that we put out on social media, which is why we've gone this route, because otherwise I get a little tiny face in the corner, which doesn't look great for social media clips. So would love to hear some feedback if anyone's willing to comment as to whether they like these sessions, as is, they're okay with it, or if they prefer when we have the slide deck as well, and we just got to figure out a better recording mechanism for the social media videos. So I'd love to hear from you guys. And if you have any other questions, please post those. And if there are no other questions, it means I've either done a terrible job and you guys are completely confused, or I've done an incredible job and I've answered all of your questions. I hope it's not a terrible job. Okay, well, I guess we'll wrap it here. Thank you everyone for joining us on your lunch hour today. I hope you found this session useful. If you joined in halfway, the videos will be available on our social media as soon as we end this session. And again, thank you for joining us on your lunch hour. Have a great day and bye for now.